This Forex Smart Start Trading Foundations module is the introduction to the module. In this module, we'll look at what is the Forex market, how Forex trading works, how price works, currency pairs, margin and leverage, who drives the market from where to where, fundamental, technical, and sentiment analysis, and how and when to trade the Forex market.
Which currency pairs to trade? The major currency pairs. The majors refer to the currency pairs that have the greatest average trading volume. A high percentage of institutional traders will focus their trades on the 5 major currency pairs. This consistently large volume generally means that these pairs are more likely to provide stronger trading opportunities. The 5 major currency pairs are the GBP USD, Euro USD, USD Swiss franc, AUD USD, and USD Japanese yen. How the sessions you trade affect the pairs you trade. As institutional traders drive the Forex market, it makes sense to trade specific currency pairs at the time that these traders place large sums of money into trades in these pairs. We'll look at the strengths of major currency pairs and which market sessions are generally stronger and more predictable in the next Forex Smart Start tutorials. How do you make profit when prices fall? If you think the value of a base currency will fall, you enter a short contract, which is also known as a bearish trade or a short trade. Click the sell button and set your sell bid price as the current market price. In this example, you would enter the short trade at the bid price of 1.25132. As there is a 0.5 spread on this trade, you would break even on this trade when the ask price falls to 1.25132 to match your initial trade entry bid price. When the price goes down, you exit the contract by clicking on the trade exit button. This closes the contract with a lower current market buy ask price. In this case, your exit ask price is 3 pips lower than your entry bid price. This means you have made a clear 3 pips profit. Because you've set your trade entry sell price as the higher price and the lower buy price when you exit your contract, you're still buying low and selling high. This is how you make profit. So first enter by setting your high sell price, and then exit by setting your lower buy price when the markets move down. The Euro USD currency pair. London morning and New York morning are the best times to trade the Euro USD. The Euro USD is the Euro versus the US dollar currency pair. The Euro USD is the second most traded currency pair in the market, with the majority of trades in this pair being executed during both the London morning session and the New York trading session. The Euro USD takes second place to the GBP USD for trade volume in the London morning session. The Euro economic data can be more complex of fundamental analysis due to the fact that this currency combines the economic data of 20 countries. The European Union's GDP is estimated to be 19.35 trillion nominal in 2024, representing around 1/6 of the global economy. Germany has the biggest national GDP of all EU countries, followed by France and Italy. Over the last 5 years, the Euro USD has recorded a consistent average daily trading range of approximately 95 pips. The Euro USD is the second in percentage of profitable trades executed by lift investor traders.
How Forex trading looks on a chart. For example, the British pound versus a US dollar currency pair. Along the bottom, we have time. Along the side, we have price. In a bullish market, trades return profit when the market rises. In a bearish market, trades return profit when the market falls. In a long market, you buy low to enter your trades and you sell high to exit. The difference between your buy and your sell is your profit. In a bearish market, you sell high to enter your trade and you buy low to exit. Again, the difference between your buy and your sell is your profit. Who drives the Forex market? The big fish institutional traders. This is a representation of the market. We have our position traders trading long-term positions. We have our swing traders who trade in between these long-term positions. Day traders that enter the trades on a daily basis in one trading session. And intraday traders who purchase multiple positions during a trading session. In taking their trades, they leave examples of trade opportunities behind for us as retail traders. As trade fishers or retail traders, we're looking for evidence to locate where trades that meet our method criteria are more likely to be found. For example, in a strong bullish pressure in our indicators at a proven level of support in price shows that long trades are a higher probability. By understanding that, we can remove short trade opportunities from our focus and focus on long trades. Then our trading method entry criteria will help us identify which trades will fit in our net. So as intraday traders, we're looking for high probability intraday trades with support from day and swing traders. They might look like this or this. Knowing what we're looking for, we can eliminate any other options that may not suit our trading method. To trade safely, let the big fish swim in front. Don't try to get in front of the institutional traders because you'll get bitten.
How do you make profit in a rising market? When trading Forex, you are actually buying and selling Forex contracts with other traders, based on whether you think the value of the currency will go up or down. If you think the value of a base currency will rise, you enter a long contract. This is also known as a bullish trade or a long trade. As an example, this is what your order window could look like. Click the Buy button to set your buy ask price as the current market price. In this example, you enter the long trade at the ask price of 1.25137. As there is a 0.5 pip spread in this trade, you will break even on this trade when the bid price reaches to 1.25137 to match your initial trade entry ask price. When the price goes up, you exit the contract by clicking the Trade Exit button. This closes the contract with a higher current market sell bid price. In this case, your exit bid price is 3 pips higher than your entry ask price. This means that you have made 3.0 pips clear profit. Your profit is made on the difference between your contract buy price and its sell price. So number one, you enter by setting your low buy price. Then you exit at your higher sell price. The difference between your buy price and your sell price is your profit. The US dollar-Japanese yen currency pair. Japan remains a global hub of technology and manufacturing, so the Japanese yen is strongly traded by institutional traders in the Asian regional trading session, as well as in the London morning and New York trading sessions. In 2023, the Japanese GDP was $4.23 trillion US, fourth behind the US, China, and Germany. The US dollar Japanese yen tends to trend and range similarly to the USD Swiss franc and USD Canadian dollar. They all have the US dollar as a base currency. Fluctuations in the Asian stock exchanges and interest rates tend to have the greatest impact on the USD JPY value. The USD JPY has been historically challenging for retail technical analysis traders to earn a consistent profit due to the regular artificial inflation or deflation of the yen by the Japanese government in their efforts to maintain the yen value at rates consistent with their economic policy. Over the last 5 years, the USD JPY has recorded a consistent average daily trading range of approximately 62.5 pips. The best sessions for each major pair. In review, most of the highest probability major market movements occur in the London morning session between 8:30 a.m. and 12 p.m. London time, the New York morning between 8:30 a.m. and 12 p.m. New York time, the New York close between 4:30 p.m. and 6 p.m. New York time, the Tokyo session between 8:30 a.m. and 5 p.m. Tokyo time, and the Australian session between 8:30 a.m. and 4:30 p.m. Sydney-Melbourne time. The major 5 currency pairs that intraday traders trade and the strongest sessions are GBP/USD, London morning, New York morning, and New York afternoon, Euro/USD, London morning, New York afternoon, Australian dollar/US dollar, Australian morning, Australian afternoon, London morning, USD/JPY, Tokyo morning, Tokyo afternoon, London morning, New York morning, USD Swiss franc, London morning, New York afternoon. These times vary throughout the year with regional daylight savings times. It's a good idea to Google current time to be sure of the time in each capital city. Which currency pairs to trade? London morning, New York morning, GBP/USD, or the Great British Pound versus the US dollar. The Great British Pound GBP/USD is the dominant currency pair in the global currency markets, with decisions being made by British institutional traders, driving price based upon announcements by British government departments. Trades on the GBP/USD account for the large majority of the volume in the London morning session between 9 a.m. and 12 p.m. London time. In Australia, depending on your local time zone, this occurs in the early evening. The GBP/USD is also recognized as one of the highest technically traded pairs due to its consistently high daily trading range, strong intraday price cycles, and its response to major recognized support and resistance levels. Over the last 5 years, the GBP/USD has recorded a consistent average daily trading range of approximately 111 pips. The majority of high probability trades executed by lift investor traders are on the GBP/USD currency pair during the London morning session. Trading outside the major market sessions. Trading outside the major market sessions is not likely to produce consistent profit. If you intend to trade outside strong market hours, make sure that the market is cycling between major support and resistance levels on your intraday market entry chart to ensure the potential to make a reasonable intraday trade profit from each intraday trade. Ideally, look for the strongest sign of a strong price rise in your trading method key analysis indicators at key levels of support in a rising market or key levels of resistance in a falling market. This shows confidence that the market is trending strongly, be more likely to give higher probability strong trade entry points. Remember that institutional traders drive the market, and if they're not there driving, generally the market will go nowhere or be too unpredictable for retail traders to find strong trade entries. Just because you're there and ready to trade doesn't mean the big fish are. Your high probability trading method should give you guidance on when to find your trades. Try to trade during the major market trading sessions, as this is where it is most likely to produce one high probability trade that day. Fundamental analysis. One of the biggest challenges of fundamental analysis is that it can be difficult to predict how the market will react to certain events. Even if a retail trader has a strong understanding of the underlying economic data, they may not be able to accurately predict how institutional traders will react to a particular news release due to the effect of data on the complex relationships between multiple related currency pairs. This unpredictability can make finding a reliable fundamental analysis retail trading strategy difficult. Another challenge of fundamental analysis is the sheer amount of data that must be analyzed. In addition to the myriad of economic data releases, traders also must stay up to date on political developments, central bank policy changes, and a variety of other factors that can affect the currency markets. Accessing up-to-date data can be costly, and the analysis is often time-consuming. This makes fundamental trading challenging for the typical retail trader looking to earn an income from trading, not just pursuing an interesting but unprofitable hobby. For these reasons, most retail Forex traders choose to trade using technical analysis.
How Forex trading works. The values of world currencies fluctuate every second. Traders trade contracts on one currency against the value of another in a currency pair. For example, the GBP USD is 1 British pound equals how many US dollars. Today, for example, the GBP is valued at 1.2792 US dollars. Traders then buy and sell contracts depending on whether they think the value will rise or fall. On a small scale, you may have done this when you traveled overseas and waited till the AUD moved up to get more local currency to spend. On an investing scale, traders make these trades with large sums of money on a regular basis to make profit on these regular fluctuations. Fundamental factors affect the strength of the currency, such as employment rates. If the employment rate is good, that usually means a stronger economy or a stronger currency. Interest rates. If interest rates are high, that usually means it's good for the economy. If interest rates are low, that usually means it's bad for the economy, and that would affect the value of that particular currency. Manufacturing. And one of the most important factors is balance of trade figures. Higher imports and lower exports is bad for the economy. Higher exports and lower imports is good for the economy. In looking at all these fundamental factors, fundamental traders working for banks and financial institutions decide whether the value of the currency is right at the current level, or whether it should go up, or whether it should go down. In this case, because there's three good factors affecting the value of the base currency, that means a stronger economy. If that's a base currency, then the value of the currency should rise. If it's the counter currency or the quote currency that has stronger economic conditions, then the value of the base currency will fall. Currency values rise and fall as a result. This is a rising market or a bullish market, or a falling market, which is a bearish market. Traders buy and sell currency contracts with each other based upon this expectation of where the value of the market is. You purchase what's called a Forex contract, or CFD, which is a contract for difference. In a rising market, you enter the trade by setting your buy price at the entry of the trade. When price reaches a certain level where you're comfortable that the value is reached its maximum, then you set your sell price. The difference between your buy price and your sell price is your profit. In a falling market, you enter the trade by setting your sell price. When prices fall into a level where you believe it's unlikely to go any further lower, you exit the trade by setting your buy price. The difference between the buy price and the sell price is your profit. Because you're purchasing a contract, you have the option to set either your buy price or your sell price on entry, depending on whether you expect the market to go up or go down.
Okay, so explain to you more about pips. Pips can be one of the hardest concepts for new retail traders to understand. Because there are so many different currency pairs with different base and quote currencies, trading in cents doesn't make, sense. So Forex is traded in units known as pips or points. A pip is the lowest commonly tradable fraction of the quote currency in the pair. The pip unit is a number at the fifth digit from the left, ignoring the decimal point in the price. This is how price looks in your order window. You have a bid price and an ask price, or a sell price and a buy price. In this case, the bid price is 1.25132 and the ask price is 1.25138. If you count 5 digits from the left, the amount that you see there, the number 3 in the bid price, is 3 pips. So reading it from the left to the right, it's thousands, hundreds, tens, units, and the last digit is 1/10 of a pip. The prices are always shown at the same time, the bid sell price and the ask buy price. Each of these prices relates to one of the 2 contracts you can execute in Forex trading. Bid and sell is for short, ask and buy is for long. The difference between the bid price and the ask price is known as the pip spread. This is the commission that you pay your broker to execute your trade. The true value of the market is the price that is halfway exactly between your bid price and your ask price. This can range from 0.6 to 1.6 pips or more, depending on the expected volatility of the currency in the trading session. Generally, the higher the volatility, the larger the spread. In this example, the difference between the bid and ask price is 0.6 pips. This means that there is a 0.6 pip spread. As a profit-focused trader, it is ideal to have as small as possible commission to pay for your trade. But if the spread is very low, it can also mean the opportunity to make profit is also low because the volatility will be low as well. How to choose which trading strategy is for you. Your risk profile. A major factor to consider is your tolerance for risk and your awareness of where risk occurs in Forex trading. Some people are just not cut out to trade leverage investments like Forex. We'll look into risk profiles, risk management concepts and strategies in the risk management tutorials of Forex Smart Start. Your goals. Forex trading is not a get-rich-quick scheme. Most people who start Forex trading aren't looking to build a billion-dollar trading empire. Those who try often are rudely awakened by reality. Most people who start trading Forex want to build an additional income stream in their spare time around their current job or business so that they can fund their other investments, supplement their income, or replace their current active job income with a more flexible, high return on time and money investment trading income. In our experience, this can be achieved by most people following the principles in Forex Smart Start and using a proven, profitable, effective trading method. Your financial and time resources. Not everyone has $1 million nest egg just sitting there waiting to be used to build their lifestyle trading income. Most people need to build their trading funds strategically. Equally, most people who are working a job or running a business, along with having personal and family commitments, have little extra time to spend 12 hours a day analyzing the market. Using an effective trading strategy that leverages consistent, repeatable, productive actions that helps you produce your desired profit in a realistic and reasonable time is a smart trading goal. Remember, the more actively you can manage your trade, the more consistent and scalable are the profits, and generally lower the risk. Most of the traders we work with choose intraday trading because of its flexibility and potential for consistent profits, whilst minimizing risk and maintaining an achievable investment of time relative to reward. How pips move as you trade. This is again your order window with your sell price and your buy price. Bid price and ask price. PIP is short for price interest point, and as I mentioned, it's the fifth number from the left, ignoring the decimal point. In this example, the bid price is 6 pips with 0.7 of a pip or 7/10 of a pip following. In the buy price, the 7 is the units and the 9 is 9/10 of a unit or 9/10 of the pip. We read right to left as 1/10, units, tens, hundreds, etc. The difference between the bid and ask price is the platform commission. To enter a long trade, you click the buy or ask price. Your long trade is profitable when the value of the bid price goes higher than your entry ask price. For example, if price moves up 1.5 pips, the value would read as 1.16282 / 1.16294. That's an increase in 1.5 pips for the currency, displaying in both the bid price and the ask price. And that's how it would look in your order windows. To enter a short trade, you click this sell bid price. Your short trade is profitable when the value of the ask price goes lower than your entry bid price. For example, if the value then goes down to 1.16221 / 1.16233, the price drop is 6.1 pips. And this is how it would appear in your order windows. Main trading strategies. Most Forex trading strategies can be broken down into 5 main types. Number 1 is position trading. Position traders look to make long-term profits over major price movements. These traders can hold onto trading positions for weeks to months. Position traders lock away their trading funds for a long period of time, low liquidity, to attempt to make larger profits by trading between major price levels of support and resistance in the market. This often involves setting large stop losses to account for short-term large price fluctuations that occur. Automated stop losses or a margin call being triggered due to spikes can lead to significant losses of capital. This style of trading is closest to share trading style and is favored by less experienced traders or traders looking for a passive trading income. This trading style generally produces lower long-term profits due to its passivity. Significant price levels, double zeros and triple zeros. Faders like round numbers. These occur on currency charts at double zero and triple zero price levels. Position, swing, day, and intraday traders all look for trade entries or exits at double zero and triple zero levels. Institutional traders may either make price run or stall by entering or exiting trades at these levels. Double zero prices. This represents the currency price reaching a new 100 pip price level. Double zero prices are when both the fourth and fifth digit from the left of the average price, the midpoint between the bid and ask price, are zero. So for example, 1.3500. On the chart, it would look like 1.3500 followed by a tenth or tenths of pips. Remember that the sixth digit is not relevant in the double zero, only the fourth and fifth digits. The sixth digit can be a 0 through to 9 and it would still be considered a double zero. Triple zero prices. This represents when currency price reaches a new 1,000 pip level. Triple zero prices are when the third, fourth, and fifth digit from the left are the average price, the midpoint between the bid and ask, are 0. For example, 1.3000. That could look in the window as 1.3000, followed by tenths of pips. That could be anywhere from 0 through to 9 and it would still be considered a triple zero. Again, the sixth digit is not relevant, only the third, fourth, and fifth digits. Position, swing, day, and intraday traders all look for trade entries and exits at double zero and triple zero price levels. Let's compare the main trading strategies. Position trading is more of a long-term strategy. It's most like share trading in its passivity. A realistic trade volume is about 1 trade per month. Position traders trade less often. They're looking for entries and exit at major price levels. Position traders generally employ a basic strategy. They often follow high-impact news announcements to determine their entries and exits. They have larger stop losses, potentially risking more of their capital. They trade a smaller percentage of their available funds. They look to make long-term profit, and it more suits a trader who's looking for low activity. Swing traders is more of a medium-term strategy. They look at their weekly price levels to determine their entries and exit levels. They look for 1 to 2 trades per week. They have a more detailed strategy taking into account more factors than position traders do. They trade medium to high impact news announcements. They have lower stop losses than position traders. They're generally more flexible with the percentage of their available funds they trade. To succeed as a swing trader, you need a plan and discipline. Swing traders generally have more control over their positions. Day trading and intraday trading is consistent short-term trading strategy. They're focusing on the up-to-date market, the current announcements in the current trading sessions. They're looking for anywhere between 1 and 2 trades per day. They have a more detailed strategy taking into account more factors than swing traders and position traders. It's most like a real business in a daily transactional approach. They often trade between the news announcements. They have much tighter stop losses, risking a lot less of their available capital. They manage their risk actively rather than using automated stop losses. They compound their profits daily to leverage their funds into larger positions. To trade intraday, you need to have a strong trading plan and discipline. Trading intraday locks in consistent profits and better manages risk overall. That's why Forex Smart Start focuses on intraday trading strategies. Fundamental versus technical analysis. One of the first challenges new traders face is understanding how to use either fundamental analysis, technical analysis, or a combination of both to make informed trade entry and management decisions. Fundamental analysis, the foundation of Forex trading. Fundamental analysis involves examining economic, financial, and other qualitative and quantitative factors that can affect the fundamental value of a currency. These factors include interest rates, inflation, economic growth, political stability, central bank policy, employment, interest rates, manufacturing metrics, and balance of trade figures, and more. Traders who use fundamental analysis pay close attention to the economic data releases and news events to assess how these factors may impact the market. This data is complex, and some traders study specific announcements for years in order to trade profitably, often never to really build a consistent, growing, sustainable income. Five, scalping. Scalpers try to make quick profits multiple times during a trading session. These traders generally hold positions for seconds to minutes. Widely accepted as the riskiest strategy, there is often little strength in the scalper's analysis due to the unpredictable price volatility when trading much shorter time frames. Scalpers often respond to market volatility or price action, chasing short-term price movements without considering the longer-term impacts and how institutional traders drive price between significant levels of support and resistance in the market. Many profitable traders who pursued scalping profits have lost all their funds. The weakness of this Forex strategy and its subsequent poor results is why share traders equate Forex trading to gambling. The best times to trade intraday. The Forex market moves because institutional traders make it move. Fundamental traders push the first money into the market in response to data coming from announcements made by government departments, federal banks, and other industry authorities. Then, with some focus and direction, institutional technical traders drive the market from levels of support to levels of resistance in a long market, or vice versa in a short market. The one thing that people making announcements and institutional traders have in common is that they are employees working a 9-to-5 job, clocking in, clocking out just like any other regular Joe or Joe employee. So this means that currency pairs will generally move stronger and more consistently when these employees are in their offices working their jobs. If there is nobody in the office on the market pushing money into trades, the price goes nowhere. It is therefore the most productive approach to align your trading schedules with the time that institutionals are most likely to enter trades and make your focused currency pairs move. One of the biggest mistakes new Forex traders make is to look for trades on the market when it's more convenient for them to trade, instead of when it is most likely that institutional traders are trading, driving money into the market, and making strong, high-probability trade opportunities.
General considerations in choosing a broker. Professional brokers are regulated by a central authority, such as ASIC in Australia, FINRA in the US, MAS in Singapore, and the FCA in the United Kingdom. These authorities regulate brokers with the emphasis on protecting retail traders in their country. These regulations will differ from country to country, and it's usually wise to trade through a broker who is regulated in your country of residence, as they will likely comply with the rules that protect you. Some brokers based in countries that have lower trader protection will offer more attractive terms, such as the ridiculously low spreads. This should be a massive red flag. Don't prioritize short-term profits over the stability and protection of your trading funds. Brokers are divided broadly into market makers and dealing desks. Market makers generally trade on behalf of clients and potentially for their broking company. Market makers will often try to find the buy to your sell or sell to your buy so that they can make profits on both sides of the commission. This can slow down transactions and lead to price slippage that can massively impact your profitability. Dealing desks send your trade directly to the live market, resulting in faster transactions. We'll look closely at the factors to consider when choosing your broker to avoid scams, minimize risk, and build a profitable trading enterprise in the risk management module of Forex SmartStart.
Who actually makes money trading Forex? According to the Euromoney 2022 survey, the largest traders of
The Forex market are banks and financial institutions. Here are the largest daily averages for the major banks. At the moment, the market is a $7.5 trillion US per day in volume. Under the other category of 34.13%, the majority of the traders in this segment are smaller banks, private hedge funds, superannuation funds, retail brokers for high net worth clients, and private traders like us. It's estimated that most major banks make up to 30 to 40% of their total annual income from Forex trading. That's profit they're making from your money. How can you benefit from trading this market? So how this works, you as a bank customer pay funds into your deposit accounts. The banks then, based upon the agreement that they have with you, can use part of those funds to trade the Forex market. The profits they make from those funds will go to their traders, to commissions and bonuses for their managers, and then eventually to their shareholders. None of the profits they produce are turned back to the bank customer. Your money is already being traded on the Forex market by these banks and financial institutions, just not for your benefit.
The USD Swiss franc currency pair. And the London morning and New York morning sessions are generally the best times to trade the USD Swiss franc. USD CHF is the abbreviation for the US dollar Swiss franc pair. The Swiss franc is the only franc left in Europe after the rest joined the euro. Many traders consider the Swiss franc a safe haven currency because, in times of uncertainty, the Swissy usually stays stable or appreciates against most of its European counterparts. In the situation where the GBP USD or the Euro USD are not strongly trading, intraday traders may find high probability trades in this currency pair during either the London morning session or the New York market session. Trading the USD Swiss franc can be a specialized niche, as trading sessions can look either very clear or very challenging, unlike the GBP USD or the Euro USD, which have a higher percentage of strong sessions. The Swiss franc took a hit in March 2023 as a result of the collapse of the financial giant Credit Suisse. The Swiss franc has recovered strongly since then and is still considered a strong currency for Forex traders. Over the last 5 years, the USD Swiss franc has recorded a consistent average daily trading range of approximately 58 pips. Number 2, swing trading. Swing traders look to make medium-term profits by trading between the multiple price cycles that occur within longer-term price movements in major currency pairs. Swing traders generally hold trade positions for days to weeks. Swing traders occasionally review their goals during their trades to see if they still have potential for profit. This style is considered passive, as traders will still often use large automated stop losses to manage their trade positions. Not actively managing trades can lead to profitable trades turning into negative trades, or at least not maximizing profit potential. Due to overlapping run and retracement cycles, an effective swing trading strategy can return higher long-term profits than position trading.
Forex trading leverage and margin. Margin and leverage can be the most challenging concepts for new Forex traders to grasp. Unlike the share market, the Forex market is a leverage market. With Forex trading, your broker lets you pay a small amount upfront to trade larger contracts. A mini contract represents 10,000 base currency units of the base currency, and the full-size contract represents 100,000 base currency units. So when you're looking at one mini contract, you're looking at 10,000 base currency units. So one mini contract represents, in the GBP USD, 10,000 GBP. In a full contract, you're looking at 10 times a mini contract or 100,000 base currency units. Again, in the GBP USD, this would be 100,000 British pounds trading to see the increase in value. If you're trading one mini contract in the GBP USD, you're trading the equivalent of £10,000. Australian-based Forex traders are limited to a standard retail leverage of 30 to 1 under ASIC rules. That means your cost as a retail trader is 1/30th of 10,000 British pounds to trade one mini contract of GBP USD. This would equal £333.33. This amount is called your margin. If your account drops below the minimum margin requirement, you cannot purchase a contract. If you are in a trade and your account balance drops below the margin, you may be exited from a trade. Converting your contract margin amount into your deposit currency. If you're trading from Australia with Australian dollars deposited into your trading account, to find your GBP USD trade margin in Australian dollars, the margin of £333.33 for one mini is multiplied by the current GBP AUD conversion rate, which will convert the base currency into your deposit currency. If the GBP AUD conversion rate is currently $1.90 Australian, multiply 333.33 times 1.9 and you'll see that your Australian dollar margin will be $633.33. If you're trading one full contract on the Euro USD, your margin is 1/30th of 100,000 euros, which is 3,333.33 euros. Multiply 3,333.33 euros by the Euro AUD rate. At the moment, say it's $1.65, and you'll find that your Australian margin would be $5,500. If you're trading any currency pairs with the US dollar as the base currency, either USD JPY or USD CHF, the margin cost will be the same because the base currency is the same, which is the US dollar. As an example, USD JPY one contract is US $100,000. Divide by 30 equals 3,333.33 US dollars. Multiplying by the Australian exchange rate of $1.55 USD AUD conversion rate, you'll see that your margin would be $5,166.66 Australian. Trading the USD Swiss franc one contract, $100,000 US divided by 30 is still $3,333.33 US. Again, multiplied by $1.55 Australian conversion rate, and your margin again is $5,166.66 Australian. When you are trading multiple contracts, multiply this amount by the number of contracts. This conversion is calculated automatically by your broker when you enter your trade, and they will let you know whether you have sufficient funds in your account to cover your margin.
Other significant price levels. As mentioned, other significant price levels can include recognized market price highs and lows, as well as other price levels that institutional traders use to find trade entries and exits between these larger market price highs and lows. They can include pivot levels, Fibonacci retracement levels, significant price swing highs and lows. In Forex Smart Start, we refer to these levels as strong support or resistance price levels. Specific strong price levels are used by lift traders to identify stronger trade entries and exits. These are detailed for lift investor traders in the Lift Investor Trader program and in the lift trading method. Currency pair average daily trading ranges in 2024. British pound US, 111 pips. Euro US, 95 pips, Australian US 71 pips, USD Swiss franc 58 pips, USD Japanese yen 62.5 pips. As we can see, the largest average daily trading ranges are the GBP USD, followed by the Euro USD, AUD USD, USD Swiss franc, and USD Japanese yen.
Intraday trading leverages probabilities. The Forex daily market volume is $7.5 trillion approximately per day.
If we look at this on a chart, we've noticed that the volume is up 14% since 2019, so it is a growing market. Percentage of the Euro USD, GBP USD, and the rest. Combining the Euro USD and GBP USD trading volume, you'll find that the total amount is about 43% of the daily market volume. So that's about $3 trillion US. The London morning session, on average, is about 32% of the average daily trading volume. So those 3 to 4 hours London morning session accounts for about a third of the daily volume. So that's about $960 billion US in 3 hours. 32% of the market in 12.5% of the day means that you're 2.5 times more likely to find a high probability trade in this trading session. Around about 50% of the market volume on the London morning session is the GBP USD, and the remaining is the Euro USD and the rest. The Euro USD moves more in the US session than it does in the London morning session. The strongest days to trade. When we look at the days that we find the strongest trades, usually we'll find that they're on Tuesdays, Wednesdays, and Thursdays. Why? Saturdays and Sundays are days we don't trade. The market's closed. On Mondays, the US market's not active in the London morning session, and there could be a public holiday. On Fridays, it's usually slower in the London morning session because London traders are waiting for the US market session push, because the US market session on a Friday is their largest market session. The highest probability trades occur on Tuesdays, Wednesdays, and Thursdays. The strongest trade entry levels, historically proven that the majority of institutional traders trade entries are on the double zeros, triple zeros, or other strong price levels that are relevant to traders driving that market session. Most institutional traders won't enter trades away from these major price levels. The least recommended times to trade. At major news announcements, here the market is driven purely by fundamental traders. There can be so much volatility that positions can be negative in an instant. Price levels of support and resistance. Any price level directly below the current price is considered a support level for price. In a long market, institutional traders would drive price up from important support price levels. Any price level directly above current price is considered resistance level for price. In a short market, institutional traders will drive price down from important resistance price levels. Major levels of support and resistance include double zero and triple zero prices, significant price highs and lows, expected current trading session tops and bottoms, as well as other recognized levels, including Fibonacci, pivot levels, and past levels of support and resistance. Why use price support and resistance levels for trade entries and exits? Each group of traders, position, swing, day, and intraday, have their own unique significant price levels of support and resistance. They will consistently look for trade entries and exits at these recognized price levels, driving money into the market at support levels in the long market or at resistance levels in a short market. Large sums of money going into the market at these levels makes the fastest, most consistent profits. Understanding where institutional traders are likely to drive the market from can help you find higher probability trade entries that will produce more profitable trades with lower risk of loss. fundamental analysis or technical analysis. While both fundamental and technical analysis can provide valuable insights into the market, they each have their benefits and their unique limitations. Fundamental analysis can be subjective and open to interpretation, in other words, unpredictable. Technical analysis is based solely on the price continuing to follow historical price movement patterns. If your trading method is not robust and hasn't been proven to be profitable in a diverse range of market conditions, it may not account for important changes in the economic or political conditions that can affect the way that institutional traders determine their trades in these market conditions. By themselves, each trading style has its limitations, reducing the trader's view of the factors that affect the value of a currency pair. To overcome these limitations, smart traders combine both types of analysis in what's called sentiment analysis. The AUD-USD currency pair. The Asian trading session is the strongest trading session to trade the AUD-USD currency pair. This is a session that covers the market activity in the time zones covering Asia and Oceania. The two major currency pairs traded by institutional traders in this session are the AUD-USD and the USD-JPY. Australian dollar versus the US dollar has the base currency as the Australian dollar and the quote currency as the US dollar. Australia is a major economic force with abundant natural resources, strong exports of natural resources, and a competitive economy. Balance of trade figures, manufacturing, employment, CPI and interest rate announcements affect the fundamental value of the Australian dollar. The Australian GDP in 2023 was an estimated $1.88 trillion, globally around 11th highest. With strong fundamental factors that affect the AUD value, many institutional traders in the region will strongly trade the AUD-USD during the Asian trading session, making it a key pair for retail Forex traders to watch. The pair is also considered a secondary focus for traders in both the London and New York sessions. Over the last 5 years, the AUD-USD has recorded a consistent average daily trading range of approximately 71 pips.